Hello everyone, welcome again. We'll start our subsequent video with different option selling strategies. But before that, I want to share one of the greatest quotes by Chris Rock. Wealth is not about having a lot of money. It is about having a lot of options. Let us understand plain vanilla strategy, which is nothing but the naked option sale. In this video, you will learn a strategy to follow in selling options in the future script that is the simplest one and favorable also. We are by no way telling that this is the barely way to sell options profitably. There are as many as option strategies around as there are traders. These strategies perform most consistently over the years. Naked options selling, although not without risk, showed over and over again that it can profit consistently in a variety of scripts. In nutshell, an outline for this simple strategy is as follows. Step 1. Select script with very long-term bearish or bullish fundamental and or seasonal tendency. Step 2. Sell options with deep out of money strike values in favor of those basics. Step 3. Choose expiration month that give you the advantage of time decay. Step 4. Define your risk on each option that you sell. We'll now look into more details of these steps. Step 1. Select correct script. In beginning your search for the best option to write for your portfolio, you must begin to familiarize yourself with the key fundamentals that affect each script, or at least the script in which you wish to trade. Technical factors can move the script on a short-term basis. However, long-term and sustained price movements are caused by the underlying base fundamental of a specific underlying. And whereas technical indicators may reflect these fundamentals, they do not determine the ultimate direction of the script. Nonetheless, short-term technical moves will often occur in outright contradiction to the long-term fundamentals. This is why non-option selling individual traders sometimes have a hard time trying to trade purely on fundamentals, at least on a short-term basis. This raises another question, that is, how do you get this fundamental information? For those wishing to study the fundamental, the first step is to know where to look for the right information. How do you obtain the facts and figures that blend to form the big portrait of fundamental expertise? A good place to start is moneycontrol.com or NSE India for conducting technical analysis. While selling option in any script gives you favorable odds, selecting the right script in which to sell premium can boost your odds and your returns substantially. If you can select favorable script in which to write your premiums, you are already halfway there. Let us understand different economic sectors in which you can have stock in the secondary script for you to sell options. Different economic sectors that constitute Nifty 50 are automobile, banking, cement, chemical, construction, consumer good, energy, oil and gas, energy power, energy and mining, financial services, information technology, insurance, metal, pharmaceutical, telecommunication. We recommend you selecting one sector of your choice based on your current understanding of that particular sector. Develop understanding in that specific industry and then pick a stock in that industry. For example, in information technology you can select Infosys, Wipro, HCL Technology, TCS and others. Let us quickly understand seasonal tendencies. Seasonal analysis is one of the most misunderstood practices in the trading industry. As an options seller, it is also your ultimate weapon. There is a good source of seasonal data available to everyone. The problem is that there are very few resources that shows anyone how to use them properly in a trading program. Seasonal tendencies, or seasonal for short, use historical record to graph the tendency for certain script to move in certain direction at a certain time of the year. Whereas these tendencies are often very reliable, their exact timing and magnitude of the movement are yet to be understood clearly. Seasonal tendencies are mostly the result of a certain fundamentals that take place in a specific script during a given period, during a particular year, and at a particular time frame. For example, quarterly results of company, rise in automobile sales during year end, budget time every year, any monetary policy announcement by the finance minister, and so on and so forth. We consider seasonal tendencies fundamental, but they are actually simply reflection in the price of regularly occurring fundamentals. Let's move to step 2, that is sell deep out of the money options. Once you have formed your basic fundamental conviction in a specific script, you're going to start looking at the strike prices. As we stated earlier, one of the major hits on option selling is the unlimited risk component, the uncertainty you are trading at the money or close to the money options. This risk is considerably nearer and is considerably additional urgent that it is if your strike are significantly beyond away from the script which you have selected. In short, know your fundamentals. A decent power of wisdom is to diminish the media and, more vital, fade public opinion or outlook. In addition, a statement do the reverse. If your fundamental study gives you the inference that the script could continue to move higher, sell the puts and let for strong adjustment. Selling premium in volatile script is an aggressive approach, and you may be in for little more fluctuation in your option values in the short term, especially if you are a few days early in your position entry. Nevertheless, it will be entire lot less variation than if you shorted the future and have been incorrect in that short period. Step 3. Choose expiration month that give you the advantage of time decay. Many option traders are tempted to sell only options with fewer than 30 days left until expiration. They do this as all additional things being identical, an option will demonstrate its highest time decline within the final 30 days of its running life. Nevertheless, many option sellers take up it for given that it implies. To get the largest hit for your money, sell option with 30 days or less time value left behind. The long time range offers a fantastic in the time decay versus distance from the money ratio. On the one hand, you can sell far enough away from the script to avoid most short-term script swings. On the other hand, you can collect the premium right before time decay really start to kick it around at 30-day mark. This allows the script plenty of room to move and allow you plenty of room to be wrong and still make money. In essence, you can often ride out the short-term plays and technical moves against your long-term view of the script. In addition to employing this distance view of a script, this approach has a built-in from a risk standpoint. Now we are talking about risk benefits. Let us assume that your long-term fundamental analysis of the script is wrong. You will stand a good chance of making money. Remember, the script does not have to move in the direction that most favors you. It can move sideways or even against for you a while. The option will still expire worthless if the script does not reach your strike. By selling deep out of the money strike, you only have to pick where the script will not go, not where it is going. Let us quickly look into the time decay graph. Many option sellers look at the graph in the statistics and conclude that the quickest decline is the final 30 days, and hence it is the best to sell options with only 30 days left over until expiration. Although this is one theory that works well for some traders, you had better be pretty good at picking short-term script direction if you hope to make money consistently with this approach. The alternative is to sell options with more than 30 days remaining. Sell ahead of the curve. Why? One justification, as we indicated earlier, is that the extra time value lets you the comfort of selling at a strike extremely far out of the money. The second reason is that if the script can avoid a sharp move against you in the first few weeks of your trade, you enter the last 30 days of options life at a much more distant strike than the seller who has waited until now to sell his option. In other comments, he has to sell closer to the money strikes to collect the same premium that you took 30 or 60 days previously. Let's discuss about step 4, that is define your risk on each option that you sell. This action is likely self-apparent if you have forever traded anything in the past. While selling option is different in many ways from most of any other investment, this aspect of it remains constant. By knowing your exit point, you give yourself peace of mind. There are two ways to lose on a naked option. Because this is extremely unlikely and in fact totally preventable, we should most worry ourselves with another way. Another way is that the script goes anti your stand to a level that raises both your margin and the cost of your option. At the same point in that reckoning, you want to close the position. Thank you very much, and we'll look into spread strategies in the next video. Happy learning.